So I'm trying to dealing with
All
my
right, welcome to the Loan Officer Training Series with the Mortgage Calculator. We will get started here in just a moment. Give us just a second here to go live on all the different platforms. I see comments already rolling in there. Definitely appreciate the comments. And great topic here for today. Definitely something that everyone needs to know. So looks like we're live on all the platforms. We'll go ahead and get it started. Go ahead and keep dropping comments there in the chat. You can also drop any questions you have in the chat as well, and Jose would be happy to answer them after we go through this training. So with that being said, let's go ahead and get it started. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president Nick Hershey and our CSO Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern is a loan officer training topic. And today's topic is going to be how to structure limited review condo loans. So definitely something very specific and some great waters that Jose can help us navigate here. Jose, are you frozen? Looks like you're frozen. Uh-oh. Oh, yeah, he fully dropped off now. So we'll give Jose just a moment to come back in here. But again, definitely something to know, especially for places like Florida, right, that have a lot of condos. So definitely important for that as well. Let's see here. Is Jose jumping back on? I don't see him yet. All right. Well, Nick, while we wait on Jose, do you want to talk a little bit about, I guess, kind of preface what he's going to be talking about here today, the problem that we're going to be trying to solve here? I guess essentially what is limited review when we're talking about this?
Well, that's what the presentation is going to be on. But limited review condo is going to be different in different cases. So there's a lot of different variations here that he's going to have to present. Florida definitely has their own laws on condos. And so Florida is always different than every state. And then every loan program is also different. And then also the occupancy type is also different. So limited review is very specific and has to do with the exact program, the exact occupancy, and even the exact state, as every state is treated differently. And even Florida within the state is treated differently as well.
All right. Still no Jose here. Do you see him jumping in on the back end?
Nope.
I don't see him yet. All right. Good morning, though, to everybody there in the chat. See lots of comments coming in. Definitely appreciate it. I do want to, I guess I'll take this time to remind everybody about our conference that we do. Anybody out there tuning in that is in real estate, especially members of our team, we do our conference every year in Miami, December 13th to the 15th. It's called Real Estate Live Real Estate Weekend. And it's a great time in Miami. Lots of panels, mixers, and then we do a VIP yacht party with free food and drinks and all kinds of cool stuff. So definitely check that out. The website for more details is realestateweekendmiami.com. We've had awesome speakers like Kevin O'Leary from Shark Tank. We've had Marcus Lemonis from The Profit. So I know some people tuning in have been to previous years. I see some people in the chat there that have came before, and it's definitely a great time. The team members can let you know. There's a lot of realtors, loan officers, people from different parts of the industry. I just got a message here from Jose saying he's almost back. So I guess we'll give him just another minute here to tune in. I apologize for the technical difficulties here. But this streaming program that streams on all the platforms is definitely a little robust and can present some problems there. So it looks like Jose's here. Jose, maybe I'm not sure exactly what happened, but you might want to turn your camera off just in case that might be eating up too much of your computer there. So why don't you turn your camera off?
All right.
That doesn't
I'm not really
happen
sure
again.
what it was. You know, I was turning. I was just with the presentation, but let me go ahead and do that, and then let me share my screen.
All right. Yeah, let's do that just to make sure that it doesn't happen again here. All right. Let's see. Are you able to share your screen, Jose?
Yeah, I'm just getting getting the slideshow up so that I can. I guess since everything was restarting, it was taking a little longer, but I am up and ready to go.
All right.
So, what I wanted to today's training definitely hits home for the MLOs in Florida. Let me see. I think I can get the camera back up. All right. For the MLOs in Florida, because Florida is treated differently than the other 49 states regarding limited review condos and just regarding condos in general. The Florida condo market tends to be a little peaky at times. So those of you with Florida license, as you know, Florida is one of the top activities real estate states in the country. And we definitely have a lot of MLOs in Florida. So this point will definitely hit home for those of you. I mean, we originated in all 50 states. So for in the other 49 states, as you'll see in the presentation, not as impactful for the primary homeowners, but let's get right into what do we mean by a limited review condo, right? Because some of you who don't originate a lot of condos may never come across this, but definitely in the condo heavy states like Florida, very important. Limited review condo is a streamlined process, which is available now. This is something I want you to understand for both conventional and non-QM loans, because a lot of times we think of limited review as a Fannie and Freddie option, but a lot of the non-QM investors have incorporated the more restrictive Florida Fannie Mae guidelines into their limited review condo process. So what exactly is a limited review? Well, it is a streamlined process which omits association budget and balance sheet review. Super important there. That's the number one culprit of why a condo would not be able to be financed under a regular review option. So that's because they may have a deficiency in the reserve account. That's the big one. They need to be collecting at least 10% of the annual budget, operating budget, into a separate reserve account. So it's really easy when you do get a condo loan, right, to reach out to all of the parties of the transaction, reach out to the buyer's agent and the seller's agent and see if anyone can provide a copy of the most recent budget. This is assuming it's a purchase, obviously. If it's a refi, you'd be reaching out to your borrower and asking them if they received the yearly budget. The owners do receive it from the association, and then they could provide the budget and you could review it and you could see if there's actually any money being collected and put into a reserve account. And if it is, and it's not at least 10% of the annual operating budget, then you're going to have a problem with a full review, and then you're going to have to go limited review. Review of the percentage of investor units is another situation with buildings that maybe have a high percentage of investors. The number, I believe, is 50%. So If it's more than 50% of the units are investor units, that's going to have an issue with a full review. That would have to go limited review. And going back a minute to the budget, obviously reserve is one of the issues, but also just in general, I mean, if there is any kind of a deficiency there, anything that is noted in the budget that's not favorable, the loan could get shut down, because in a condo, the health of the association is an integral component to the maintaining the value of the property, right? If the association goes into a deficit situation, they're going to have to hit units with special assessments, and then more than 15% of the unit owners are delinquent in their payment. That's a big one there. So what will a limited condo verify? What will the limited condo review verify? Well, no hotel services or mandatory rental pool or front desk, right? So we know there's condos that may be operated as a short-term rental. So that's an individual component of the unit. But as far as the building and the association, that's one of the things that the building cannot have. Front desk, to receive guests, right? That's gonna fail the loan for this type of financing. No single entity owns more than 10% of the unit is something else they will ask. Does the commercial space, they're going to ask what percentage of the building is commercial space. It cannot exceed 25%. If there's any pending litigation, now if there is, then you would ask for some documentation, and then the condo review underwriters can review it and see if there may be reserves to cover the contingency, the contingent liability should they lose, or insurance to cover, and money in reserve for the out-of-pocket. Hazard and flood insurance is always going to be applicable, or should I say going to be reviewed. Flood insurance as applicable if it's in a flood zone. FEMA just redid their floodplain maps July 31st of this year. So some properties that were not in a flood zone are now in a flood zone. Be on the lookout for that. Now, also, a limited condo review will verify. Now, this is going to depend. One, I think, caveat I wanted to note here: limited condo review forms are requirements are going to depend on the investor that the loan is being sold to, and if there are any overlays. That's if we're talking about a conventional loan, Fannie or Freddie. And then on the non-QM side, obviously, it's going to depend on the guidelines, because some may ask, what is the percentage of units 60 days or more past due on the assessment payment, the monthly association fee? It seems like the magic number is 15%. So if it's more than 15% of the units are more than 60 days or more past due, it's going to fail. That's going to be a big issue. At that point, you're going to have to go financing for a non-warrantable condo, right? Limited review condo loans resolve some of the issues that make a condo non-warrantable, which is the issues we're covering right now. But if you fail some of these limited condo review parameters, then you would go to a non-warrantable condo, non-QM loan, specifically targeted for these issues. And then obviously there's going to be adjustments possibly in interest rate, cost, and loan to value. So now let's go on. So just to be aware now, I did specify overlays that may cause differences in how it's reviewed, and on the agency side, conventional, and specific guideline requirements for the different investors. So, as I was just stating, right, make sure that you use the correct investor-specific limited condo review form, because that form, depending on whose guidelines or overlays are applicable, is going to ask you for different information. Some are very short, a lot shorter than others, and ask hardly anything. So obviously when you're structuring your loan, if that's going to be an issue, that's one of the points that you would definitely want to take into consideration, right? Obviously, interest rate, cost of the rate, all those factors, but also if it's a condo, what's the state of the health of the association, right? Financially and with their documentation, and is that going to entail then customizing that loan or tailoring it, taking into consideration that possible deficiency there on the condo review that would require limited condo review. So now here's where we break it down, like I was mentioning, those that are doing the condo loans in Florida and those that are doing the condo transactions outside of Florida. There is a big difference, right? In the transactions outside of Florida, notice primary residence, 90% max LTV and CLTV, right? The CLTV would be if you added a HELOC, right? So you may want to go 80% on the first to not have any mortgage insurance and a 10% HELOC, right? And there you're at your 90%. So either one loan or combo loan. Second home is 75% LTV and CLTV, and investment is 75% LTV and CLTV. So those are more relaxed guidelines than Florida below for the limited review condo loan, because there we have primary residence 75% max on the first and 90% CLTV. That's where our our HELOC combo purchase loan comes into play, where you go 75% LTV on the first, right? Normally that borrower is going to have to come in right with 25% down, unless you then combine it with a HELOC for 15%, and the borrower comes in with only 10% down. That's a super amazing transaction for Florida condos, where frankly the majority of the condos do not have reserves, but that's going to change. There are some laws that are going to be changing that, so there's going to be a lot of special assessments to be on the lookout for that's going to affect people's qualifications. Second home, notice it's 70% max on the first, 75 CLTV, and investment 70% max on the first, 75% max CLTV. So those are still pretty good numbers. Now, something that I definitely want you all to take into consideration is the scenarios under which a condo review is not even required, right? So there are situations when they are eligible for what's referred to as a waiver of project review. And those would be a detached condo. I've actually financed those. It looks like a single family home, right? Has a yard, even has fence around it, but it's a condo. The owner does not own the land. The owner does not own the structure. They own the inside from the walls in, just like with every other condo. There's an association that takes care of the exteriors, and there's an association fee paid. Those properties do not have to go through a project review. No condo questionnaire needed. A condo project that is 2 to 4 units, unless one of the owners owns more than one unit, that's a different situation there. Units in a PUD project, and then here's one where this is really digging deep, but Fannie Mae to Fannie Mae limited cash out. Now, please be aware, limited cash out is a terminology for rate and term, what you would consider a rate and term, where they're only taking up to, typically it's going to be no more than $2,000, can go net of the cash of the refinance. So Fannie Mae to Fannie Mae limited cash out refinance to a max of 80%. So if your LTV 80% on a rate and term, and it's a Fannie loan, refinancing into a Fannie loan, guess what? You do not have to get a condo questionnaire at all, right? So do be aware. That's a good one, because I know that does happen in certain scenarios. So to recap here, what are the solutions that are offered by limited review condo loans? Well, breaking it down here, it permits financing properties normally not eligible for Fannie Mae, Freddie Mac financing due to the issues that we've talked about, the financial issues of the association, including the most common that they're not collecting at least 10% of the annual budget into a reserve requirement. So if you were to be going full review and not limited review, because, for example, you want a borrower that wants to buy with 5% down or 3% down, right? That's what they really want to do. They figure condos are less expensive than a detached single family home. They want that to be their first purchase. They want to come in with the minimum down payment, but that's only going to be possible with a full review condo loan. So do be aware. And if it's FHA, that's a whole different story. It has to be FHA approved, not just, so you gotta, that's a spot approval at best. So do be aware that that's the reason why you want to do a full review in the first place. But if it's not possible, then you have to be aware to advise your borrower that they're going to have to come in with at least 10% down outside of Florida and 10% down in Florida if you can originate the transaction as a HELOC combo loan. And there are additional requirements for the HELOC that may not be the same requirements as for the first loan, which is DU or LP, right? So do be aware of the challenges that may face for the Florida transactions that are going to be the combo loan. So that's the first one there. The second one is do be aware, like I mentioned earlier, that non-QM guidelines incorporate Fannie Mae's more restrictive Florida limited review guidelines of 75% LTV max. That's how they deal with limited review. They go to the more restrictive one, regardless of the state. Doesn't matter what state it's in. That's what it's going to be. And the the 70% when it's an investment property max LTV. There is no CLTV type scenario for these loans that's going to be higher than the LTV for the non-QM loans. So do be aware of that when you're structuring your non-QM loans, that it is possible to do limited review. And in some cases, we have investors that have a very limited review. Like one of our options only asks for do any of the is it the 15% or more, what's the percentage of accounts 60 days or more, and they look at 15% as the threshold, and that's it. As previously stated, the primary limited review or second limited review loan first mortgage can be combined with the HELOC for 90% CLTV. And last but not least, something to be aware of, you heard me mention non-warrantable condo loans as an option when you fail the limited review. Why would you not go straight to the non-warrantable condo loans? Is going to be because the limited review condo loan is going to be usually higher LTV for the occupancy type and lower interest rate and a lower cost to the rate as well, much lower cost to the rate when it's a regular full doc Fannie Mae 10% down 90% LTV loan as opposed to a non-warrantable condo loan non-QM at possibly 80 or 85% LTV. So definitely some great tools here to help you originate and increase your lending footprint. And do look to the mortgage calculator for all of your limited review condo loans, as well as agency and non-QM.
Perfect. Thank you, Jose. I don't see any questions here, but definitely, again, amazing info for everybody to know, and especially for the Florida licensed people for sure. So, still no questions. We'll go ahead and wrap it up. Remember that we do this at 12 p.m. Eastern every week, every Tuesday, Wednesday, and Thursday, where we do a new loan officer training. So, thank you everybody for tuning in, and we will